name is Jim Schlagweg. I'm speaking to you today because I have a large background, 25 years, in wealth management and in asset management. Demographics, plus in particular boomer retirements, I believe are going to have an absolutely profound impact on the investment markets. Test me and see if I'm wrong. Take a look at any of the stock market indexes, draw a line at the year 1981, that's when boomers start moving in, and compare the progress of those indexes or that market before boomers hit and after boomers hit. The impact is startling. We're going to start to experience, beginning this year, and it will escalate, a really different mix, a different proportion of asset buyers and asset sellers in this country. Let me give you an example of what I mean. In my book, I use this expression a lot, prime seller. And I mean by prime seller a man or a woman who is aged 65 to 69, who is in retirement or who may be contemplating retirement. This is a person who is probably beginning, if not in full force, moving from stocks into bonds or moving from assets into cash to raise money for retirement. This is a person who may be even thinking of downsizing her residence in order to raise some money for retirement. If you compare, for every one of those people in 2005, we had 8.3 prime buyers. Those are people aged 35 to 54 in their peak income years, their peak investing years, their peak consumption years. So just remember that ratio, past tense, 8.3 buyers for every one asset seller. If you look at the year 2025, here's what happens. We go from, for every one prime seller, we'll go to only 4 prime buyers. What I'm suggesting is that the inventory of assets that will come to the market will be very large, and relatively speaking, the number of people that we have to buy those assets, at least domestically, Americans, is shrinking. The argument against this, I just read the Senate commissioned a report to study whether baby boomers would or would not have an impact. And they felt that there would be a lot of asset sales, but it would not cause market disruption. And the conclusion was based on this reasoning. I want you to bear with me for a second. One, it said that foreigners were, while our society aged, foreigners in many countries, India, China, Brazil, Indonesia, were going to have a shift, and many people with wealth coming to the market that would look for U.S. assets. And second, it said, well, you know, if you look at past people retiring, they never had to sell off a lot of their assets. And of course, the third function was, it doesn't matter whether they sell off or not, because frankly, the vast majority of us in this room probably have little or no impact on the market after all. The people, according to this study, that have impact are people, the 10% of the wealthiest people in the country who can move blocks of billions of dollars at a clip and can affect the market. I suggest the following. One, let's not count on foreigners buying us out of this one. Then comes the question of, well, are we really not sheltered from danger because in the past when people invested, they never had to sell down all of their assets? They kept the stocks. They kept their bonds. I would argue, unfortunately, what I said earlier, past history will not explain the future. Because in the past, when our parents and grandparents retired, the likelihood was that they could count on a pension. And today, only 20% of the population can. So the difference will be, gone are the days of the gold watch when you retired, gone are the days of having someone pay your way. Instead, you're on your own. Three, remember conventional wisdom. If you go onto any website, you're told, in terms of asset allocation in the traditional way, you're told that you should, as you age, move gradually out of stocks and move into bonds, right? If you look at the famous target date funds, that's what they do. You can check. They kind of inch you back. So that by the time you're in your 50s, you probably only have 50% in equities, and it goes down when you're in your 60s and 70s substantially. So people following that advice, which is not, I don't think, very good, but if they follow that advice, they're going to find themselves moving their holdings from stocks and from real estate into less expensive real estate and into bonds and cash positions. And by the way, even if they don't, then our pension funds have to do that to begin paying the pensions to the people who qualify for them. So I think there is going to be an impact. There is going to be sales, and the sales are going to be very large.